Welcome to our Q4 and FY18 earnings conference call. Today I am joined by Mr. Sukumar Srinivas, Promoter and MD, and Mr. Alex Varghese, Chief Financial Officer, and Strategic Growth Advisors, our Investor Relation Advisors. We have uploaded our updated result presentation on the exchanges last evening, and I hope everyone had an opportunity to go through the same. Before getting into the quarterly and yearly performance, let me take a few minutes to give a brief overview of our performance in FY18. We have added 23 new stores in FY18, spread over 1.25 lakh square feet. These stores were added across our existing geography in South India. We concluded 2 takeovers in Q3 and Q4 respectively of Vaigai Sanitation and JP Sanitation. Our takeover of stores of Vaigai and JP last year had performed to our satisfaction. We are working on tighter and efficient controls and systems and processes, as well as cost levers to further improve the profitability of these stores. We have also upgraded 40 stores, and these now offer the expanded range of products currently available with Shankara. In continuation to our strategy, we plan to add 15 to 20 stores in South India every year, apart from any inorganic opportunities coming our way. In FY18, we continued on adding depth across our existing product categories to provide a variety of products under one roof. We now have associations with over 125 brands across various product categories. In the second half of FY18, we also started work on an e-commerce website in order to build on our omni-channel capabilities. We have launched our website under the domain name www.buildpro.store. It caters to a wide product portfolio ranging from plumbing, bath and faucets, construction material, electrical and appliances, kitchen and walls, and flooring. The online presence will facilitate the product discovery process for our customers and also complement our physical store strategy. We expect our online presence to increase our brand equity with customers in the coming quarters. GST was introduced in July 2017, which caused some instability in the market. In November, the GST rates were revised again, and since then we have witnessed a stable regime which has resulted in an improvement in demand and also subsequent conversion in sales. On the industry front, we have seen a good pickup in demand, and we have benefited from that in the quarter 4. Further, going forward, we see multiple levers of growth, namely store expansion, category expansion, increasing share of wallet of existing customers, as well as acquiring new customers. In addition, we continue to be positive on pursuing inorganic growth opportunities. Now focusing on the quarterly performance of the company. Q4 was a good quarter for us. The total revenue for Q4 stood at 761 crores as against 600 crores for the corresponding quarter last year, representing a growth of 27%. The sequential growth has also been robust at 22%. As highlighted in the last quarter, revenues are not a like-to-like comparison post the GST regime. Before GST, excise duty was a part of our revenues. However, post-GST, excise duty is subsumed in GST and is no more a part of our total revenue. Therefore, adjusted for this, our revenues grew by 43%. EBITDA for the quarter stood at 54 crores from 45 crores on a year-on-year basis. EBITDA margin stood at 7.1% in Q4. PAT stood at around 22 crores for the quarter, up 16% from the same quarter last year. In terms of the overall performance of the company for FY18, the total revenue stood at 2,549 crores, up by 10.3%. Adjusting for excise, the revenues grew by 21%. EBITDA stood at around 176 crores with EBITDA margin at 6.9%. The PAT stood at around 74 crores, up by 26%. Now let us focus on the segmental performance of the company. Retail sales saw a robust growth for Q4 FY18 of 43% and stood at 378 crores as compared to 265 crores for the same quarter last year. We have seen a positive operating environment for the business in the fourth quarter. The growth was primarily driven by increased penetration and improvement in the sentiments for the business. All our key states have performed well. Q4 FY18 EBITDA grew to 41 crores, up by 51% from 27 crores year-on-year. Now, if we see FY18 retail performance, the overall sales stood at around 1,220 crores versus 980 crores for FY17. EBITDA grew to 130 crores, up by 35% from 96 crores in the previous year. The contribution to the total revenue stood at 48%. Adjusted for excise, same-store sales growth stood at 41% in the fourth quarter and 27% for the full year. We have historically been growing same-store sales by around 20%, and we are targeting that going forward. Average rental cost for leased outlets stood at around 17 rupees per square feet per month. As on date, we have 129 stores. The total area of the stores is at around 5.05 lakh square feet, with an average store size of around 3,900 square feet. The total rental contributes to 0.67% of the total retail revenue. The sales split is broadly 40% coming from Tier 1 cities and the balance coming from Tier 2 and Tier 3 cities. The average ticket size per transaction was around 25,500 rupees. For the quarter, we have added 5 stores. Of the total sales, construction materials constitute around 65%, interior and exterior products around 18%, our new product categories around 12%, and the agricultural products around 5%. We are working on deepening our product portfolio and building connects with a number of principals. Enterprise sales. This segment contributed 236 crores for the quarter 4, up by 25% as compared to the same quarter last year. Its overall contribution stood at around 31% for the consolidated revenues of the company. Our focus here is to increase our share in the bespoke processes as it gives us better margins and inroads into customers. This share now stands at around 30% of the overall sales. We continue to focus on cut-to-length, made-to-order requirements. Top 10 customers continue to contribute around 10% of our revenues. Enterprise sales for the full year stood at around 805 crores. Our channel sales during Q4 FY18 stood at 147 crores, up by around 1% compared to Q4 FY17. This segment now contributes 19% of the consolidated revenue of the company. The number of dealers stood at around 1,800 as on 31st March 2018. For the full year, the channel sales stood at 524 crores, down by 8% compared to the last year. Few highlights of our processing and in-house supply chain. The company has 12 processing facilities with capacity utilization of around 90%. Sales from our own products contributed 58% of total sales. During the year, in the second quarter, we shifted one of our processing facilities from Surat in Gujarat to Chegunta in Hyderabad. This was done to ensure better utilization levels on the back of availability of raw materials, which was hampering production and sales in Surat. To conclude, we are seeing strong growth momentum in our retail segment. We continue to work on deepening our presence across our retail verticals and expanding our range of offerings. With this, I open the floor for discussion.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Karthikeyan VK from Suyash Advisors. Please go ahead.
Yeah, hi, good afternoon. I had a couple of questions. One is, could you clarify how the same-store sales growth is calculated? The reason I ask is, if I look at the breakup you have provided for same-store revenues and therefore the growth, it seems that the new stores incrementally are contributing lesser. So just to understand how exactly that calculation happens. The second question was with reference to balance sheet. So could you take us through how to think about the working capital cycle for the business as a whole?
Sure, Karthikeyan. So in terms of how we calculate the same-store sales growth, so when we have computed the number for the full year FY18,
yes,
as on 31st of March 2018, what we have done is we have taken the stores that were in existence as on 31st March 2017, and we have then taken the revenues that these stores generated in financial year FY17 and the same stores, what is the kind of revenue that they have generated in FY18. So 106 stores which were existent at the point of 31st March 2017, what is the kind of revenues that they have now generated for this year? And that's the way we have computed the same-store sales growth.
So when I look at your FY18 to 17 numbers, for example, if you see, you've said same-store revenues were 1,110 crore rupees and the 23 stores that you added gave you something like 83 crore rupees. Am I, whatever that number is, 1110. So therefore we're talking about 79.
That's the right answer.
Right. So, okay. So, so it takes time for these stores to reach a certain level of meaningful revenues. Is that correct?
That is a bit skewed number also because what has happened is that there's a GST impact. So,
no, I'm reading out the adjusted numbers only.
Yeah. So actually last year the revenues were including excise. So the relevant number possibly to look at for last year would be 871 crores, which was the adjusted for excise sales numbers. So that 871 crores now stands at 1,110 crores.
Yeah, sure. Okay. And the other question on balance sheet, because I see that certain items are heavier than usual. So could you take us through the working capital cycle?
Yeah. So we are broadly a 45-day working capital business across our various verticals. What happens is the balance sheet is also prepared as on a particular date. And we have seen a very strong growth in Q4. In fact, our March revenue stood at 292 crores.
Right.
The all-time high for us as well. And because the revenues in the March month were high, the effective reported numbers as on 31st March also appear high. But if we look at the relevant working capital days basis, this revenue, or even if we say on a Q4 basis, this will be around the 40-45 day mark.
Right. And that would be the same across retail as well as the enterprise and channel business, or would it be different, the working capital cycles?
No, the retail will be more a 25-30 day business. Okay. And the channel enterprise will be more a 65 day business.
25-30 you said, right?
Yeah.
Oh, thanks so much. And I'll come back for further questions.
Thank you. The next question is on the line of Rahul Agarwal from ICICI Prudential Life Insurance. Please go ahead.
Yes, thanks for taking my question. I just have one question regarding this segment assets that we have given in our press release. So when I see this unallocated part, it looks pretty high in the whole mix. What exactly is this 352 crores of unallocated assets in a?
Yeah, hi Rahul. See, the way this happens is that we have a front-end business, which is a retail channel enterprise, and we have a back-end, which also is a processing facility. We have fixed assets which are deployed in these facilities. And to that extent, there will be certain of these assets which cannot be immediately allocated to the various segments. So when you see those, unallocated assets, it's largely because of our, let's say, processing facilities or any common infrastructure that is getting shared across the three divisions.
Got it. And this channel enterprise, the increase we have seen quarter over quarter in the assets, is it mainly to do with the increase in the raw material, in the metal prices and all? Or is there something else also in that?
No, so actually there has been some increase, especially in the enterprise side. Q4 enterprise revenues have gone up, so almost a 25% increase in Q4. So it's not as much linked to the metal price increases.
Actually, there has been, hi Rahul, this is Kumar here. I think there was a very robust, sudden boom in the inquiries, and particularly from an infrastructure point of view, and also in a lot of building sectors, which I think we saw in the last quarter, which, go into our enterprise segment. So I think that was primarily the reason for a pretty big upsurge in the, the growth in the enterprise segment.
Okay. So just last question from my side on is there any inventory gain this quarter?
There would have been some gains. In our estimate, the overall gains would have been around 5 crores for the quarter. Because what happens is that this is on the basis that on a month-on-month basis, prices have gone up by 3 to 4%. And we keep refreshing our inventory more or less on a 30-day kind of a cycle. So, so that's the kind of an average, and all of those gains may not have accrued to us. Some of it we may have had to pass on to our customers, and we may not have caught on to the cycle, on the exact dates. So to that extent, we anticipate around 5 crores of inventory gains for the quarter.
Got it, sir. Got it. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Pratesh Chheda from Lucky Investment Managers. Please go ahead.
Sir, if you could give what is the retail business PAT, you've given the number till the EBITDA level. And in the balance sheet, if you could tell what is retail business balance sheet.
So, so in terms of profitability, we have given the profitability of the retail segment. So the retail segment delivered a EBITDA margin of around 10.7% for the quarter and for the year. This is at a store level. There will be certain other corporate overheads that will come below that, which will be possibly around 0.5%. In terms of the balance sheet, the way it happens is that you can assume that around 35% of the overall capital employed is towards the retail part of the business.
35%?
Yeah.
And could you give the retail PAT if possible?
We can come back to you. So basically, we'll have to do some allocation in terms of, our interest costs, etc. will have to be pro rata allocated, between the two segments. But retail would be a fairly profitable business.
Okay. And second, I want to check on your expansion plans for FY19 and FY20 in terms of stores and square feet.
So we are looking to add around 15-20 stores every year for the next 2 years. And this is what we have done in the last year as well. In addition to this organic growth, we have also done a couple of inorganic transactions the last year, and we've added 6 stores through that. And we will be positive and continue to explore such inorganic opportunities as well. In terms of the square footage from our existing store size, possibly a 60 to 80,000 square feet addition per year is something we anticipate.
CapEx?
So the CapEx, the way it works is that we're looking at around broadly around a 50 lakh, around a 1 crore per store kind of a CapEx. So this will include our interiors and the structural work.
Includes inventory?
This doesn't include inventory.
How much of inventory?
This will be around 50 lakhs.
So basically 1.5 crore capital employed per store?
Yes.
Okay. Thank you very much, sir.
Thank you.
Thank you. The next question is from the line of Saumil Mehta from BNP Paribas. Please go ahead.
Yeah, hi. Thanks for the opportunity. So my first question is, you mentioned that the existing facilities have touched about 90% utilization. So any plans to expand facilities, and the capital raising announcement, is it in conjunction to that? And if not, what could be the purpose of that 300 crore capital raising?
So we are, in terms of our capacity utilization, we are at 90%, and during the course of the next year, we should be hitting full capacities. And we are looking to do some element of value-added processing facility expansions in our network. a part of that 300 crore QIP or 250 to 300 crore fundraise that we're broadly looking at will be towards such kind of activities. But in terms of the overall use of proceeds for the equity raise, we're broadly looking at three heads. The first being takeovers or acquisitions. The second being capex. A large part of it will be front-end stores and some of it back-end, and a small part also working capital.
I think predominantly the proceeds of the QIP we are looking at is towards the mergers and, to take over, I won't say merger, but to look at acquiring new businesses, as part of our inorganic growth. So we are seeing, and we've done two of them, as you all know, and I think we are seeing a lot of opportunities that are coming up where I think we are very bullish on that particular area.
Sure. So my second question is, in terms of the classification now, the retail EBITDA, what you have delivered is about 41 crore versus 28 and a half last year. But in the press release, when I look at the consol segment, it looks to me that the retail EBIT is 41 as well. So is depreciation a part of the unallocable expense? Or no, I'm not able to reconcile the EBIT and EBITDA numbers because the presentation mentions of a different EBITDA number, whereas the press release has a different EBIT number in the retail. Both seem to be the same.
So the segmental EBITDA, so the segment profit is actually the EBITDA because the depreciation has been taken as a part of the unallocated expenses.
Okay. So the entire depreciation, which would be that would be a large part of the unallocable expense, or there are certain expenses beyond
crores. Overall, it's around 14 crores.
14 crores. So that entire amount would be largely depreciation.
Yes.
Sure. And so my last question is with respect, balance sheet. In terms of, we've seen that the total interest cost for the full year has come down, whereas debt has gone up. So other bank charges come down, or the interest rate for us, which we are being charged, that has come down, or both?
Yeah, so there have been, so it depends on the utilization levels also during the course of the year. So the utilization levels have been a little high. In fact, Q4, our interest cost has also increased a bit as compared to previous 3 quarters. And that has contributed, to our higher interest, relative higher interest cost. So while the overall interest has come down, the debt levels have slightly gone up.
Okay, and the average interest rate?
On account of the acquisitions that we have done, the 2 acquisitions on which almost 35 odd crores have been deployed for the 2 acquisitions. And this again is an end of period number where in the Q4 we have seen strong growth.
In relation to that, can you share some plans on the JP sanitation? How do you see that business and how should that business be ramped up over the next 3 to 5 years?
So the JP is largely in 2 categories primarily, which is in the flooring side and the plumbing and sanitary ware side. This is at around a 4.5 crore per month kind of a business. Last 2 months we have delivered around 10 crores from this JP stores. These are reasonably profitable, but I think there are opportunities for increasing the margins here. And what we're looking to do is that, and since they are in Bangalore and we have some additional products that we can offer here, how we can cross-sell our other product categories to their customers and possibly use some of their connections and their relationships into our customer base.
I think basically, apart from a business, we also acquire a lot of customers. There's a good customer base. We also, acquire sort of a supplier base. So I think if you ask me in terms of numbers, I would say we are looking at a 20% plus growth for the JP Sanitation. Of course, the brand itself will merge slowly into the Shankara Buildcon over a couple of years. So I think here the basic idea was to acquire customers, acquire certain suppliers, and of course, whatever is the top line that we acquire to.
Sure. Thank you. And all the best.
Thank you.
Thank you. The next question is from the line of Maulik Patel from Qtr4 Securities. Please go ahead.
Couple of bookkeeping questions. What is the revenue from the manufacturing or processing which has gone to the retail in this quarter? And also for the full year.
Maulik was just coming back to you on the numbers. CFO is just quickly taking out the details. Just give me a 30 seconds.
Sure.
Around 50% has gone to retail.
And what is the processing revenue this quarter?
426 crores.
426?
Yes.
And what could have been in the EBITDA of all the three subsidiaries combined for the full year and this quarter as well?
See, all the processing is in all the subsidiaries only.
Yeah. No. So what is the EBITDA contribution from the subsidiary in this quarter and the full financial year?
For the financial, it's around 85 crores. And
85 crores?
Yes, 85 crores.
Okay. And what could have been for the quarter?
For the quarter, it's around 27 crores.
27, yeah. Okay. One question, I think, on the balance sheet side. It appears that the inventory has gone a little higher than, even if they're adjusting to this two acquisitions, we have done that. Any thought on how do we streamline our inventory going ahead?
Yeah. So actually, inventory has gone up slightly in terms of as compared to last year. Some of the acquisitions have possibly increased our inventory levels by around 20 odd crores at least, and 25 actually. And what has also happened is that if you look at Q4 or even March numbers for the last 3 years, this year we have seen a substantial growth in the March revenues. So the relevant number for the same for March month last year was 209 crores, and the year before that was 194 crores. So as opposed to that, we have seen a revenue of around 292 crores for this March. That's a 40% increase month on month for March. So adjusted for that, if we see our inventory days have actually moved from around 36 days last year to around 43 days this year, basis March sales. And some of that will be on account of the acquisition that we have done. Some of it is also because we are adding more product categories and hence inventory levels are not as efficient. Some will be new retail outlets, but yes, I think on the inventory side, we have seen some element of slightly higher requirements.
Okay, great. Thanks, that's all.
Thank you. Before we take the next question, we would like to remind participants that you may press star and want to ask a question. The next question is from the line of Harit Kapoor from IDFC Securities. Please go ahead.
Yeah, hi, good afternoon. Just two questions. Firstly was on the, refurbished stores. So we've done a large quantum of stores refurbishing for the for FY18. Just wanted to understand, what your experience has been, in terms of new product placement there, how, customer entries have, or even enterprise entries have improved there. And if you could just give some sense on that part of it.
Yeah, so there in the for the upgraded stores, I think we've seen a good revenue uptick as well. We're seeing more customer inquiries and more sale conversions starting to kick in. In fact, if we do a comparative same-store sale growth for our upgraded stores for this year, the number stands at around 22%, as opposed to our overall system average of around 16%. So we have been able to grow at a much higher pace for our upgraded outlets.
Super. The second thing was, if you, how much would be the proportion of the JP and Vaigai revenues for the quarter in the retail business of in the retail revenue of 378 crore?
So around 15 crores odd would be the overall revenues. Sorry, 25. So 15 for Vaigai and 10 for JP broadly. So 25 crores would be the contribution.
Okay. I think, you already alluded to what the kind of revenue potential can be for JP. Just wanted to understand the path to profitability for these two, units. How close are they to your average EBITDA margins now? And if they're a little behind, then how much time will it take to get there?
So Vaigai was actually, it was almost a turnaround kind of a situation. It was not profitable when we took it over. Currently, it's tracking around the 6% kind of EBITDA level. And we feel possibly it will take us around, say, 2 to 3 quarters to kind of move it to numbers of our overall system.
Yeah, I think it should hit that 10% plus maybe in about a couple of quarters because we're doing a lot of let's say revamping and in terms of cost rationalizations, etc. So like we've taken measures to cut down on their warehousing costs, which was very high. So I think shift to warehouses is happening currently. So I think Vaigai will definitely by probably the second or third quarter of this year should be on line with our regular because of better it. And as far as JP sanitations go, I think we are at about 8% at this point of time. So I see that probably in this quarter, the end of this quarter, it should be in line with our EBITDA.
That's great to hear. Just the last question was on, the broader demand trends. Clearly, Feb, March, and especially March has been fantastic for you. Do you see, obviously not this quantum, but do you see, the broader demand trends continuing to be strong over the next, 12 months or so? And if yes, are there specific categories where you're seeing this, or is this broad-based in the market?
Harit, if I were to stick my neck out, I would say yes. I see this very strong demand because April has also been very good. Normally, most businesses, you see that upsurge in, March and so on. And then April tends to sort of slacken. But this year, we've seen very, very good demand and good sales in April, which is just slightly lower than March, which is a very good augury. And I see that, overall in the last 4 months, one, of course, the GST blues are over, and we do see a lot of strong demand from the housing sector, both individual as well as group housing and so on. So I think there is, there does seem to be an undercurrent of a demand pull. So I would, go as far as sticking my neck out and saying I do see a very strong demand this year. On a broad-based manner, I can't really pinpoint into category A or category B. But once we look at the construction sector and the building sector, if it goes up, then there's a sort of a demand across the various categories.
That's great to hear, sir. All the best. Thank you.
Thank you.
Thank you. The next question is from the line of Hiral Desai from Aniways Portfolio Managers Private Limited. Please go ahead.
Hi, Siddharth.
Hi, Hiral.
So I had one question on the working capital. So, obviously I understand that the inventory and debtor has gone up because of strong growth that you've seen in March. The payables also versus September are actually up about 60%. So I wanted to understand, what is driving this increase in payables?
So I think
largely restricted to the processing side because, rest of it is really, internal entries. So just trying to understand that.
Yeah, so on the processing side also we have been able to, because of some of the increases that we have seen on the debtor side in terms of, our collections, we have also in some sense stretched out our creditors and squeezed them more. And I think that's what we've been able to achieve, especially in the last quarter.
What is a more steady state number for payables, let's say, going ahead?
I think on an overall basis, a 45-day working capital business is something that we can work with.
Okay. See, the other question that I had was, in terms of, when we had met, we had discussed the breakup of profitability between the subsidiaries and the standalone business. So I'm just trying to understand. So if I look at the standalone gross margins for the entire year, they are at about 7.7%, while the consolidated is at about 14.7%. So that implies almost like a 60% gross margin on consolidated minus standalone. So what is the P&L of the processing business? So what would be the steady state gross margin on the processing side?
So actually, I think when you have computed the gross margins from the headline P&L numbers, that may not give you a very accurate figure.
Yes.
Because what happens is there's one line item called other expenses, in which there are a lot of costs getting clubbed. So, as a thumb rule, possibly what you can assume is that we have an overall operating cost structure of around 2%. So our EBITDA margin plus 2% would be a broad guidance for the gross margin of the business.
Okay.
And in terms of margins that we have done on our processing side, so last year we have done around 5.7% of EBITDA margins in the processing side of the business.
Okay. The other is, would it be possible to share the volume of steel that you sold in full year FY18 and FY17?
Volume. Around 4.5 lakhs is what we have sold last year, 4.5 lakh tons.
And what would be the number in FY17?
Just one sec. So last year we've done around 4 lakh.
Okay. And lastly, Siddharth, I was looking at slide number 12 in your presentation, which basically gives you the breakdown of the retail business.
Yeah.
So, despite, even if I take an adjusted SSG of about 16%, the EBITDA per square feet has actually gone up only by about 2%. So does that indicate that there is not really any operating leverage in the business?
No, I would not, possibly the other way that you can look at it is that our average store size has also increased.
Right.
So, over the last 6 years, our average store size has moved from 3,000 square feet to 4,000 square feet.
Right.
As a system average. In fact, if we compute the average store size that we have opened for the last year, that is at around 5,000 square feet.
But Siddharth, the contra to that would also be the fact that the new product share would have gone up, right, over, let's say, FY18
No, fair
over
point.
FY17.
So that's a fair point. All I'm trying to say is that an EBITDA per square feet, especially, in say tier 2, tier 3 cities, where we have an opportunity for having a slightly larger store, and we have opened some larger stores as well. So, it's not, an immediate increase that we get for a slightly larger store.
Okay.
So, the productivity of the store will, there will be possibly a step function that will happen. It will not be a linear, increase. It's an increase in store size a bit.
Cool. Thanks, and all the best. And Siddharth, if you could just revert on the queries which were pending.
Yeah. So we have that in mind, and my apologies for not having responded, but we will do that. Sure.
I'm sure you had a phenomenal Q4, so you would have been tied up with that.
Yeah. I have that in the back of my mind, and Alex and I are just smiling here that we have not been able to get back, but we've been really tied up.
All the best, guys. Thanks.
Thank you. Thanks.
Thank you. The next question is from the line of Prachi Kodaikal from Bay Capital. Please go ahead.
Yeah, hi. I just wanted to know, for your retail business, what sort of marketing or advertising activities you do, if any, and what will be the spend on that?
So we are looking so we have already been doing some level of marketing activities. It's more of what we would call a direct marketing, where we do customer meets, in-store influencer meets, and things around that nature. We have also been conducting some level of loyalty programs for some of our more loyal customers. But this year we're looking to kind of take it to a slightly larger scale. We're looking at a much more, may call it elaborate influencer meet program, which we are planning to start shortly. We're looking at a more focused loyalty program, which will possibly be rolling out shortly for our influencers. We're also looking at some level of media, above the line media, so to say, some element of radio, some element of, some increased presence of our brand to start off with.
So broadly, what we plan to do this year to be very focused. So if we take up a particular area, it would be, a sort of a mix of, let's look at it, outdoor media. There would be local media. There would be television or cable in that particular area. So I think apart from direct marketing initiatives, so we are looking at it very focused from area to area and geography to geography. Even in a city, like say Bangalore, we would be focusing on North Bangalore, and then we'll move on to South Bangalore. So this is broadly the plan we have in mind. If you look, ask me about the ad spend, I think currently we have earmarked about 2.5 crores for this year.
2.5. Okay. Got it. And the other question was on your finance cost. What is your average borrowing cost?
Our average borrowing cost is around 10-11%.
Okay. Okay, so the finance cost that reflects in your P&L, does that have some other cost element as well?
Yeah. So there are around 3.5 crores of 3.5 crores of other finance cost, other charges that are non-interest. They are more like say collection charges, CMS charges, processing charges, etc.
Okay. And another question was, I think earlier I just missed it. You had said that you're looking to raise funds. What was the amount that you had mentioned?
So we have taken a board. The board has given us an approval to raise up to 300 crores, subject to shareholder approval. So we are broadly looking at a 250-300 crores, subject to shareholder.
Okay, got it. Thank you. That's all. Thanks.
Thank you. The next question is from the line of Asad Desai from Emkay Global. Please go ahead.
Yeah, hi. Thanks for taking my question. My question is on your slide number 11 in your presentation, where you've given the total area increase of around 120,000 square feet. So this area increase is completely on account of new stores, or you added space to the existing stores also?
Largely new stores only.
And what would be the split, roughly?
95% you can assume would be new stores only.
Okay. So when you take same store growth, you've taken 106 stores in the base year. Do you adjust for any area increase within those stores also while calculating same store growth?
No, we only look at absolute revenues that the store has delivered.
Okay, so these, if you expand the area in these 106 stores, the same store growth will also go up by that much for next year.
Yeah, if they
that's how it works.
Revenues, yeah.
Got it. Yep. Thanks. That's it from my side.
Thanks.
Thank you. The next question is from the line of Charandeep Singh from Girik Capital. Please go ahead. Charandeep, your line is unmuted. Please go ahead. Charandeep Singh, your line is in the talk mode. Please go ahead.
Yeah, can you hear me now?
Yes, please go ahead.
Great. Could you please tell me what is the size of the total cash credit limit of the company as of today?
Total limits are 590 crores.
Okay, 590 crores. And what is the rate on this, the interest rate?
This would be around 10 to 11%.
Exactly? Would you know?
So these are from various banks. We have 6 banks.
Okay, got it. So it varies between 10 and 11%. I got it. And tell me, what is your average utilization through the year? Max and minimum?
Around 300 crores for the year.
300 crores average?
Yeah.
Okay, and any other facilities, non-fund based, that you'll need at all? Like, are there any guarantee facilities or anything that you'll use?
There are no guarantees that we have.
Okay, great. That's all I have. Thank you.
Thanks.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Somil Mehta from BNP Paribas. Please go ahead.
Yeah, thanks for the opportunity again. I wanted to ask the March and April month, which have been seen very strong, traction. Is it largely led by across the board products or more by steel and some of the ancillary products and less by the... Because, what I want to understand is, given Karnataka state election, can that lead to this sort of, unusual uptick in demand?
No. I don't think the elections really have any impact on consumption.
Okay. No, in terms of, our contractors and typically the social work gets to be on an uptrend.
We are facing the other challenge. We are facing the other challenge that, labor is not available.
I think this month the challenge is the opposite, where a lot of leave and absenteeism under the pretext of going to their homes for voting and so on. So I don't think elections really have any great impact on, consumption in these kind of products.
Great. And second question is with respect to the refurbished stores now. Are we done with all the 80 stores which we were going to refurbish, the old ones? And what has been the average increase in square feet because of that? Because earlier we had plans to increase some sort of square feet in the old stores.
So largely we have done around 40 odd upgrades, and we possibly will have around 30-40, possibly more this year, more to do this year. There is not a lot of square footage increase that may have happened because of these upgrades.
Okay, because we earlier had plans to increase it by a bit so that, we can have more and more products since we are upgrading on our product portfolio. Or we are just utilizing the space much more efficiently than before so as to accommodate all the new products.
Yes, that's right.
Perfect. Thank you.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Thank you very much, sir, for the opportunity. So my question pertains to your retail segment. Now, currently, given the base, our revenue is growing at a much larger pace at maybe 35-36% on an annual basis. And given you also mentioned that we are seeing very strong demand. But as we kind of reach scale, maybe in 2 to 3 years, given the kind of demand or strong. So what sort of sustainable growth do you see? Basically, our kind of business or our kind of model should be able to see on a sustainable basis?
Yeah, I think one is the intrinsic growth that we have. We are seeing a lot of possible market shift also happening from the unorganized or the standalone segment to organized players. Okay. So in terms of an opportunity size, it's a very large opportunity. The overall building material segment, possibly in 2-3 years' time, will be 7-8 lakh crores in size.
Okay.
And we are looking for a small percentage of that overall market share.
Right. So according to you, this 30-35% kind of a growth is a sustainable growth?
No, I'm not saying that. All I'm saying is that in a 2-3 year time frame, I do not think that our runway is, getting,
drier,
shortened in any which way.
Okay, understood. Sure. That's from my end. Thank you very much.
Thank you. The next question is from the line of Huzafa Katradiwala from JAF Management. Please go ahead.
Hi, team. I just want to know, would it be possible for us to break up the retail revenue further into plumbing, construction material, bath and faucet, kitchen and all, if it's possible? We just display that in our investor presentation.
Yeah, so I had actually mentioned those on the call. So the overall construction material is at around 65%. Interior exterior is around 18%. Our new product category is around 12%. And irrigation-related agriculture products are around 5%.
Thank you so much. That's it. Thanks.
Thank you. The next question is on the line of Sanjay Lada from Perfect Research. Please go ahead.
Yeah, hi sir. Thank you for the opportunity. So my question will be, what is the credit policy you have for your channel, enterprise and retail sales? And how do you judge the credit worthiness of a customer? And do you deal with credit sales and bad debt if any occurs?
So the last part I didn't get.
And how do we deal with credit sales and bad debts if any occurs?
So to answer the first part, so the credit decisions, we do not offer credit to new customers. We possibly look at some level of transactions with them. Initially, we start out with cash-based transactions. Once we have gained enough comfort, possibly over a 6-month period or so, we continue with cash, and once we have done that, we start with small doses of credit, which will be largely linked to the kind of business that they have done in the last 6-month period with us. The credit decisions are not taken at a store level, but at a cluster level, where one more senior person also gets involved. In terms of or possibly if we get references, a strong reference from some of our existing customers, we may possibly look at those angles as well. And
is there any credit loss or bad debts occur in the past?
So there have been instances, while they have been very less, and as a percentage of our overall size of our business is very less, but there have been instances of bad debts. We have a bad debt provisioning policy as well, laid out, and the board has approved of a provisioning policy.
As per the India's norms, so we do have a provisioning policy in the balance sheet itself.
So my second question will be on what competition are we facing from online players who are our major competitors online and offline, and how cheap or expensive are we from competition in terms of pricing?
So online, we are not, I would say, facing any competition in that sense. It's not something that is concerning us right now.
And is there any competitors in offline?
Not, so there are standalone players that will exist.
Offline, I would say it is an extremely competitive market. You have enough and more in the mom and pop and standalone building material stores are plenty. So I think like any business, there is an adequate amount of competition. But in the organized space, there is nothing as of now or nothing significant as of now. And as far as the online business, I would say that it has not yet gained traction as far as the building material products go. And we also have an online portal, so where we are, where we can offer the omni-channel kind of presence.
So in the space of retail, what in the single, my question will be for the customers, Shankara, apart from having a complete range of products, is our product cheaper versus competition of single brand stores?
We would say that we will be very competitive vis-a-vis our standalone stores, because we will be able to possibly procure at least at the same price, if not better than the standalone stores.
So at the same price, the branded stores and is the same price?
No, it will be better.
Possibly will be better off.
Yeah. So can you quantify the numbers in terms of percentage or in terms of anything?
We'll get back to you on that.
So my last question will be, in how many categories are we present in home improvement and decoration space? And what are the new segments that you are looking to enter in the near future?
So overall, if you look at our overall, at a business level on the retail side, we are in around 75 product categories. I would assume in the new product categories, possibly around 15 odd would be in the, let's say, the new product categories. And we have identified the broad product categories, and we are building our presence there. I don't think there are any major product segments that we are currently not in. What we may look to build over a period of time is depth in each of these product categories, and building the next level of, the smaller products, the smaller accessories. So while the larger product portfolio is there and the broad product category representation is there, we'll need to work on the product depth.
Okay, sir. Thank you so much for the opportunity. Thank you, sir.
Thank you.
Thank you. The next question is on the line of Harit Kapoor from IDFC Securities. Please go ahead.
Yeah, hi. Just had one more. Just wanted to ask you, so if you look at the EBITDA margins of both the segments and you adjust the GST revenue for it, the EBITDA margins have come off on the retail and the channel and enterprise side. Now, they are fairly consistent in the last 3 quarters, so that's good. But if you could just remind me, why the margins were a little higher in the base quarter, is it a product mix thing or something else that you could kind of highlight on both the segments?
I think the Q3 and Q4 have had some impact of the takeovers as well. We've had some transaction costs also linked with these takeovers. And in addition, what we've seen is that we've seen growth, very strong growth. I think possibly because of some of this growth may also have come from our base construction materials, which may be slightly lower margin as compared to the overall business. So that could have been possibly one more reason for a slight decline.
Makes sense. That's it from me. Thanks.
Thanks.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for their closing comments.
Thank you everyone for joining us. I hope we were able to answer all your queries. In case you require any further details, you may contact us or our investor relation advisors, Strategic Growth Advisors. Thank you.